Hi everyone, I'm James Harte from littlefishfx.com. Thank you for joining me for this week's Forex Education Hour. Among the indicators that we've looked at so far in some of the recent sessions, such as the RSI indicator, stochastics and MACD, we've been focusing only on indicators which appear in a sub-panel below our charts. But in today's session, we're going to take a look at two indicators which are plotted on the actual price charts themselves. And these are, of course, moving averages and Bollinger Bands. It's really great in these sessions, actually, to get to look over so many different aspects of technical trading again and discuss these different areas, because I'm often reminded by just how many areas of technical analysis are really great to focus on. And it also kind of reminds me of my own journey in trading and how I've tried out different strategies, looking at a ton of different indicators and methods before settling with what suited me best. And indeed, moving averages and Bollinger Bands are no different. There are some really fantastic ways that you can use these indicators. And the main thing is that even if you don't go on to use them, it's really beneficial to get a solid understanding of what these indicators mean and how they can be used, because then you'll start to build a broader appreciation for how the rest of the market is trading and the sort of stuff that other participants take into account with their trading. So, you know, maybe you're on Twitter a lot and you see people posting euro dollar has just crossed its 200-day moving average, or monthly RSI on cable has just gone overbought, or you find yourself searching for what stochastic divergence is. So it's really useful to get an understanding of what these different things mean, and then you can make up your own mind and find out what is useful to you, because you never know which method or indicator is going to be most helpful to you until you get an understanding of them. And so that's really what we've been trying to do with these sessions, is sort of build a beginner's guide to Forex, if you will. So with that in mind, let's crack on and start looking at the topics of the session. So again, if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. Okay, so first of all, what are moving averages? Moving averages essentially give us a visual representation of the average of price as defined over the last X period. So if our moving average is set to 10 and we're on the daily chart, that's giving us the average of the last 10 days. If we're on the hourly chart, then a 10-period moving average is giving us the average over the last 10 hours. So the reason that it's called a moving average is because with each new period that unfolds, the look-back period moves up one to cover the latest period and then removes the oldest period from the calculation. So it's constantly updating itself. So here you can see we have an example of a moving average, and this is a default 14-period moving average displayed on an hourly chart. So this would give us the average of price over the last half a day or so. Now, one very important thing to point out early on is that there are a few different types of moving average. And in fact, there's actually quite a range, but the ones used most commonly and the ones that you're most likely to see referenced by traders and see used on charts are the following. So first of all, we have the simple moving average. That's the moving average that we just saw in that first example. And this simply measures the average price over a given period. Again, as I say, constantly updating itself, so constantly reflecting the most recent data and removing the oldest data. We then have the exponential moving average. This moving average does the same thing, but its calculation gives more weight to recent prices over earlier prices. And then finally, we have the TMA, the triangular moving average. So whereas the exponential average places more weight on the most recent data, the TMA places more weight on the middle data of the period. So as I say, there are a whole bunch of moving averages that have slightly different calculations, and you can find traders and systems using them all. So definitely play around with the different moving averages and find the ones you like. But as I say, these are certainly the most common ones, definitely the most widest used. So let's take a look at some of these in some examples and talk about what their function is and how we can use them. So here you can see we have the three different types of moving average that we just looked at. We have the regular simple moving average, which is the yellow line. We then have the exponential moving average in red. And finally, we have the TMA, the triangular moving average, in purple. And as you can see, they really aren't hugely different to one another. Basically, all the different variations that you find just give a slightly different smoothing, and so only tend to adjust the actual average very slightly. You can see that for the most part, they're pretty much moving in and around each other very similarly. They only tend to diverge from one another at the turning points where they're accounting for the swings in price. So those are the different types of moving average. Now you know what they look like. We need to think about how we use them, how we can actually integrate them into our trading and build trading opportunities around them. We use them in our analysis to identify trading opportunities. So with moving averages, traders tend to use them in two ways, really. One is for the moving averages to act as a guide to the direction and the state of the market. And then the second is to explicitly use them for trading opportunities. So in terms of using moving averages as a guide, essentially the traders will reference a particular moving average whereby if price is trading below its average, then the market is seen as being bearish and trending lower. And if the market is trading above its average, it's seen as bullish and trending higher. So the actual moving average becomes a sort of bull-bear line in the market, a pivot, if you will. And this is the most common way that we see traders using the moving average as being indicative of a bullish or bearish trend in the market. Now, sometimes traders will use a single moving average as a reference point, e.g. price is below its 200-day moving average, suggesting that the market is bearish. But other times you'll actually hear traders reference a crossing of 2 or perhaps even 3 moving averages as indicating a trend. So in these situations, the crossing of a shorter term, faster moving average through a longer term, slower moving average indicates the direction of the market. So what are some of these moving average crossovers that you might come across? Well, obviously there are hundreds of different combinations that you can employ, and again I advise you to do exactly that, to play around with the MAs yourself and find settings that you like. But to get you started, some of the most common ones that you'll come across are the 9 and 21 day crossover, the 55 and 100 day crossover, the 50 and 200 day crossover, and the 100 and 200 day crossover. So let's take a look at examples of these and talk about what we're seeing. Okay, so here you can see we have 9 and 21 day crossover. So the orange line is the 9 day and the yellow line is the 21 day. Again, this is on daily chart. So you can see this is a fairly short-term crossover that we're referencing here. This is roughly half a trading month crossing through a full trading month. And you can see how it tracks price quite closely, and it's fairly sensitive to the different swings in price, the different turning points. You'll notice that we get quite a lot of crossovers generating a fairly high frequency of trading signals based on the crossover method. And it actually does quite well in picking out these nice little expansion moves, even within a fairly range-bound period such as this. Here we have the 55-day and the 100-day moving average crossovers. Now obviously this is a much longer term crossover we're looking at, and you can see instantly that the moving averages are far less sensitive to the swings in price, and we have far fewer crossovers to generate trading signals. Here we have an even longer term crossover. We have the 50 and the 200-day moving average crossovers. And this is a really widely used crossover. You'll come across a lot of traders and analysts referencing this. It's used by a lot of trend traders to denote the direction of the trend in a particular market. And you might often hear a bullish crossover in these MAs. So again, we're always talking about the shorter term, the faster moving average crossing through the longer term, the slower moving average. So you might often hear a bullish crossover in these moving averages referred to as a golden cross, and a bearish crossover referred to as a death cross. Now again, you'll note that the moving averages, as we would expect, are less sensitive to price. They're not tracking the current or the recent swings as well. And the crossovers, although they are few and far between, they actually tend to last for much longer time. And finally, we have an even longer term set of moving averages, the longest ones that we're going to consider today. This is the 100 and 200-day moving average crossovers. And again, as you'd expect, these are even less sensitive to price and have even fewer crossovers. So these are what we mean when we're talking about moving average crossover. Some of you might have seen these lines on charts before and not really being quite sure what they were or how you could use them. So these are moving average crossovers. And if we look at this example here, typically we will find that traders will either enter the market as the moving averages actually cross over. So in this instance here, if we look at this period where we saw the 100-day cross down below the 200-day moving average, we'll either see traders getting short here as the moving averages cross over, anticipating that this bearish signal will produce a downward trending market, or we will look for traders using the crossover as a guide. So as part of their analysis, they'll pull up a chart, apply their moving averages, identify immediately that the 100-day moving average has crossed below the 200-day moving average, indicating to them that they should be looking for bearish opportunities, that the market has a bearish bias, and so they will then look to use other methods to identify selling opportunities. And it's some of the stuff that we've looked at in the past, simple stuff: breakdown through key support or a retest of broken support, retracement into bearish trend lines, or general price action setups. All of these things that we've covered in the previous sessions. So again, if you haven't seen any of these sessions, it's definitely worth checking out those recordings if you haven't seen them. So these opportunities, in line with using the moving averages as a directional guide, the opportunities that we use for entering based on moving average analysis can actually come directly from the moving averages themselves. So one method that you will find some traders using is where they look to establish a trending market. So again, they'll look to identify a crossover, look to establish a trend in the market, look to establish a bias, and then they will look to enter on retracement to the moving average. So in a bearish example, they'll look to use a retracement to the moving average, with the moving average providing resistance to get short, and in a bullish trending market, they'll look to use a retracement to the moving average, looking for the moving average to provide support to get long. So if we go back to our 50 and 100-day moving average slide, because this has a really good example. Okay, so we can see here that we have the 50 below the 100-day moving average, indicating a bearish market, and price is moving down quite sharply. So what we would look for in this situation is price to retrace back up into these averages where we could look to sell. And you can see here we have a nice short entry where price was trending down strongly with both the moving averages turned lower. Price then popped up at this point, retested that 50-day moving average before selling off again and continuing to move down in that bearish trend dictated by the moving average crossover. However, we can see at this point here that we popped up, we actually broke through the 50-day moving average at this point, but you can see that as we initially tested the 100-day moving average, we got a nice little kickback off that. And again, because this is a daily chart, although that move itself is quite small, that probably equates to a couple of hundred pips at least. So these are some of the other ways in which you'll often find traders looking to use moving averages, is that once they've identified a trending market, they're looking for a retracement back to the moving averages to identify entry points to trade a resumption of the trend. Now, aside from just giving us a bull-bear view of the market, moving averages also give us some clues as to the actual state of the market. So where we see moving averages turned heavily in one direction, as we do here, and price pushing in that direction, then we know that price is likely in a decent trend. However, once the moving averages start to turn sideways and start to flatten out like we see here, then that's very indicative of price entering a range-bound period, or at least entering a corrective phase. So along with giving us some indication as to the direction of the market, they can also help us outline what state the market is in, e.g. if we're trending, if we're ranging. So these are the basic ways that traders use moving averages. comparing price to its moving average to indicate direction of the market, referencing the position of two moving averages relative to each other to indicate trend, and indeed using the actual crossing of moving averages as an entry point, and then finally even using a price test of the actual moving average to offer another entry point into trending markets. So the question is, do you want to use moving averages? Should you use them? Well, again, as with all technical elements, there are obviously pros and cons. Moving averages can catch some fantastic moves in the market. I mean, if you pull up any chart you like and stick on a 50 and a 200-day moving average, and you will spot some fantastic trends that the moving averages capture perfectly. The issue is, however, that they also go through some horrendous periods where price is chopping around all over the place and the moving averages are constantly caught on the wrong side of the market. Now, the issue with using moving averages and the disadvantage to using them is simply down to the lag that is present in the calculation of the moving averages. So moving averages are measuring past periods of price action. They're not predicting the future. So while they can certainly capture some great moves, two things occur. One, they often give back an awful lot on winners. So if you're trading from moving average cross to moving average cross, there will be a lot of times where price moves sharply away from the moving average and is in really big profit, but then comes all the way back before the MA is crossed again to let you exit the trade. Actually, if we take a look back now at the 100 and 200-day crossover, you can see clearly what I'm talking about. So right in the middle of the chart here, you can see we get a really nice bullish crossover. Price spikes higher, we get this really volatile expansion higher. We move up by around 600 or 700 pips. You're in a really great trade here. You've just caught the bullish crossover. You're up several hundred pips, looking really good. However, look what happens. We hit resistance and price reverses sharply and comes all the way back down. So we basically get all the way back to the entry point before price crosses over at this point to let you exit that trade. So all that profit is simply given back because the moving averages don't respond quickly enough to price. So what are your options? Well, either you can look to build some sort of system out of how you trade these crossovers, such as looking to build in a risk-reward parameter system. So for example, you could think, right, I will risk 200 pips on a moving average crossover and look to exit 600 pips per trade, so an average of 3-to-1 risk-reward. Instead of trying to hold on to these trades and catch longer runs, you can look to bank at a certain target on each trade. This will help you avoid some of these situations where price spikes higher or spikes away from the moving average crossover and you're in really good profit, but then because the moving averages are so slow to respond and price can be so volatile at turning points, it comes all the way back and you end up giving back a large portion, if not all of your profit. So that's one way that you can look to mitigate against that event. The other option that you have is to simply use shorter term moving averages. Now, these moving averages are more responsive to price. They track the recent and current swings in price a lot better than longer term moving averages. However, these moving averages won't have the same big runs that you get in the longer term moving averages. So where we get these really huge trending moves, you generally won't get as many of those, or at least not to the same magnitude, if you're using shorter term moving averages. However, you will, and also they're subject to a lot more whipsaw, so you tend to get a lot more false signals on the shorter term moving averages where they cross over simply as price has expanded from a certain point and then rotates. So these are the pros and cons that you really have to weigh up when you're looking to use these moving averages, and this really comes down to doing your own research, doing your own back testing, looking to get a solid idea of the different sorts of opportunities and the different ways in which you can manage these different moving average methods. So with moving averages, again, it really comes down to how well you can make them work for you. There are some really big funds that have built incredibly profitable systems out of moving average crosses. There are a lot of manual trend traders who rely on them. So it's definitely worth taking a look at some different time frames and playing around with different settings to see if you can find something that works well for you. Because as I've said many times in these sessions, it really doesn't matter how well someone else is utilizing a specific component or operating a specific strategy. If you aren't able to make it work for you, and different traders respond differently to different things, you know, different time frames, different methods, different strategies. So if you're still in the process of figuring out how you want to trade, then I hope these sessions are giving you some really useful insight and prompting you to do your own research and figure some stuff out for yourself, because that is what will really make the difference to your trading. So with that in mind, let's move on to the other topic of the session, and that is Bollinger Bands. So what are Bollinger Bands? Essentially, Bollinger Bands are just a moving average with some added functionality. So in addition to the moving average, which is typically a 20-period moving average as defined by John Bollinger, the man who invented them, we also have an upper and lower line which form bands around price, and these are standard deviations of the average, and these give an indication of volatility in the market. So let's take a look at the indicator and explain what we're seeing. So this is what the indicator looks like. You can see the middle line that we have running through the bands. This is our moving average, and then we have the upper and lower limits around price, which actually form the bands, giving the indicator its name. And again, the default settings here are a 20-period moving average, and the deviations are set to 2, meaning that the upper limit is 2 standard deviations above the average, and the lower limit is 2 standard deviations below the average. So when the bands contract like this, and when we see the bands tightening up like we do here, this demonstrates that volatility has reduced. And where the bands are wider, as they are here, this indicates that volatility has increased. So that's the bottom line to the indicator. It's very simple, very straightforward, and again, it works on all time frames. Here we're looking at a daily chart, so this is giving us the 20-day moving average of price with 2 standard deviations of that average to either side of the market. So how can we use Bollinger Bands? Well, Bollinger Bands actually present some really interesting opportunities for trading, because if we think about the information provided to us by the indicator, we have the moving average, which we know can be a decent indication of general direction in the market, and then we also have some information on market volatility. So how can we use this information? Well, the first and the most basic way to use Bollinger Bands is a method called the Bollinger Band fade. And you might have guessed this already, but essentially the premise behind this method is that as price reaches its second standard deviation to the top side, price is identified as overbought and momentum is stretched. And similarly, as price reaches its second standard deviation to the downside, it's classed as oversold and downside momentum is overstretched. And so in each of these instances, we're simply looking to trade a reversal from these levels. Okay, so in this slide, you can see exactly what I'm talking about. Look how over this whole period of price action, which actually spans roughly a 6-month time frame, look how well the upper and the lower limits of the Bollinger Bands catch the turning points in price. Okay, sometimes they might not be as specific as at other points, but generally you can see that each time price moves into one of these levels, we're tending to see a reversal. So essentially in these instances, what we're looking to do is target a reaction off the upper or the lower Bollinger Bands. Now, you could trade this in a fairly aggressive way, whereby you simply trade the strike of the level, and by that I mean you simply enter as price touches the Bollinger Band. Or you could look to use price action to identify confirmation at the level. Alternatively, you could look to drop down onto the lower time frames and wait for this price action confirmation. And the reason that I suggest using the lower time frame is that sometimes the reaction on daily charts will actually negate an entry point to the trade. So if you look at the reaction that we had from this candle, for example, so you can see that price traded up, touched that upper Bollinger Band, and then was aggressively sold off. Now, if we were waiting for the candle close to get short from this Bollinger Band touch, you can see that we'd be entering almost right back at the moving average point. Now, it's key to point out that if we're using this method, then really the best outcome that we can look for, or the best outcome that we advise to play for, is where we're simply looking to short from the upper Bollinger Band, targeting a move back to the moving average, or getting long from the lower Bollinger Band, targeting a move back to the moving average. So where we see a reaction like this that's so aggressive that the candle closes almost all the way back to the moving average, well, obviously our risk reward is totally compromised here, because if we're getting short at this point here and our stop is above this candle, well, instead of getting a 2-to-1 return, we're actually risking roughly 2 or 3 even just to make 1. So again, looking to identify price action on the lower time frames can help us to get a tighter entry to these trades. So let's take a quick look at that. Okay, so this is exactly the same period of time that we saw in the previous slide, but all I've done here is overlay the daily Bollinger Bands onto the H4 charts. Okay, so this is exactly the same period, but look how much tighter you can get those entries when you're looking to fade the Bollinger Bands if you use the higher time frame Bollinger Bands on the lower time frame chart, especially that top example that we referred to where we saw such a sharp reaction from the daily candle. Well, if we're using the H4 charts, you can see that we were actually able to get in just below the upper Bollinger Band. You can see that candle actually closed just below the upper Bollinger Band. So instead of getting in all the way down here, we're actually able to get in very tight, very close to the Bollinger Band, improving our risk reward greatly. So obviously the period that we just looked at is a fairly range-bound period of price action where you can see prices simply rotating higher and lower, and it's tracking the Bollinger Bands very well. But one thing that we need to consider here is that, as with oscillators that we saw in the oscillators webinar that signal overbought and oversold momentum, where we're looking to fade Bollinger Bands, it can get a little bit tricky when the market starts to trend and starts to push hard in one direction, because they tend to sort of flag ride along either the upper or lower band. So as price really starts to push in one direction, we can really start to get a lot of signals in one area. And whilst for the most part these can hold, you can see here we're starting to push higher, but price is still reversing from these higher points. Generally, once the market starts to trend properly and we start to get these really big expansive moves, then we can start to get false signals, which make it difficult to use this fading strategy. However, we can moderate this strategy to make it really effective in trending markets and to help us trade with the trend instead of against it. And essentially, all we want to do is, once we identify price as trending and pushing hard in one direction, we want to wait for retracements in price that make it back to the opposing Bollinger Band to allow us to fade the move in line with the overall trend. So as price is pushing higher, instead of looking to short from the upper Bollinger Band rather, we'd wait for price to retrace to the lower Bollinger Band, giving us an entry to get long. So let's take a proper look at an example of this and talk about that more closely. So in this example, you can see that we have the euro dollar moving along in a sideways range at highs. The Bollinger Bands are quite flat, indicating a lack of direction. They're also quite tight here, indicating a lack of volatility. But then once we break through these lows here, once we break through this support period, you can see the Bollinger Band starts to widen out, showing us that volatility is coming back into the market and price is pushing lower. We're trending down. You can see we're riding along that lower Bollinger Band, and this is what I'm talking about. If we're looking to use that classic Bollinger Band fade method, well, in trending markets, we're really going to get turned over, because you can see here it's just pushing along that lower Bollinger Band, giving us false signal after false signal. So what we want to do is wait for a retracement in price that comes across to the upper Bollinger Band, as we can see at this point here. And you can see that this gives us the opportunity to get short in line with the dominant trend. So we know that price moving to the outer limits of the Bollinger Bands signals overstretched momentum. So where we have a bearish trend in play, we want to identify short-term periods of overstretched, overbought momentum, which will allow us to get short in line with the dominant trend. You can see we sell off from that first touch here. We then get a similar setup here where price pops higher, just tags that upper Bollinger Band, and then once again we get that opportunity to sell it down. So this is a really great method that you can look to use, and again it comes down to utilizing some of the other elements that we've looked at, such as structural analysis, support and resistance, and identifying trending markets, because again, if you look up here, the Bollinger Band fade is working really well in this sideways range bound market where price is just oscillating higher and lower, rotating between those upper and lower bands. But once we start to push, once we start to really trend, you can see the Bollinger Band fade method really goes out of the window, and that's where we want to wait for price to be retracing to the opposite side of the Bollinger Band to give us that entry, to give us that trend resumption entry. So a really great way to look to use Bollinger Bands, and a really great way to bridge that gap between range and trending markets. So the final method that I want to look at today is actually how we can use the information that the Bollinger Bands give us about volatility. So we talked about a contraction in the bands demonstrating low volatility and an expansion in the bands demonstrating increased volatility. And we can actually use these two dynamics to create trading opportunities. So we know that the market moves in cycles of expansion and contraction, trend and range, breakout and correction, and the Bollinger Band give us a neat visual cue as to when this is happening, such that we're actually able to form trading ideas based upon what the bands are telling us about the market. So in this slide, look at the information that the Bollinger Bands are giving us about the market. Firstly, we can see we have price trading pretty much sideways up here. Bollinger Bands are very tight, very flat, indicating a lack of both volatility and direction. We then see price breaking down through that support level. The Bollinger Bands start to widen, displaying the increased volatility with the downward trajectory indicated by the moving average, which gives us the bearish trend. We then see price starts to pause and contract here, showing once more that volatility is leaking from the market, direction has dried up. However, at this point you can see we turn lower again, the Bollinger Bands start to widen out once more as price breaks down in line with the trend, showing us that volatility is coming back to the market. We've got that clear directional cue by the moving average, and then once again you can see that as the momentum leaks out of the market here and the direction stalls, the Bollinger Bands turn sideways and they start to contract. So think about, in each of these instances, the really great information that the Bollinger Bands are giving us about the market. They're telling us what's happening with momentum. They're telling us what's happening with direction. And so what are our opportunities with this information? Essentially, all we want to do is look for periods of contraction following an expansion in volatility to then play an anticipated breakout and a further expansion in volatility. So this is a classic with trend breakout play utilizing the Bollinger Bands. So where we see price break to the downside like this and the volatility increasing as shown by the widening Bollinger Bands, we know that this won't last forever. We know we're going to get a pause and a consolidation, and so once the bands start to tighten up and they start to contract and price starts to grind sideways like this, then we need to be on the lookout for a breakdown to play a continuation, anticipating that we can catch the next phase of expansion in the trend. And you can see we get some great opportunities to trade using this method. So we get the initial breakdown through these lows, you can see depicted by these two lows here. So we have nice double bottom support. That gives way, price sells off here, stalls out, Bollinger Bands contract. We then break lower here, trade down into this period. We can see the Bollinger Bands once again start to contract and tighten up. We get another small breakdown here before price really starts to tighten up. Volatility totally gone at this point. Price is just chopping around, holding the support level, and then boom, you can see we break down through those lows. Bollinger Bands widen up. We know that we're into the next phase of expansion here. And then look, once again at the very bottom, we get another opportunity. Price trades all the way down to this level, bounces here, and you can see that as direction and volatility ebb away from the market, the Bollinger Bands indicate that by flattening up and tightening up. And so then once again we look to simply play a continuation of this move. We look to play a breakout, and you can see we get that at that point where we break through those lows and the Bollinger Bands widen out, showing that volatility is once again in the market. So this is another way, a really great way that we can look to use the Bollinger Bands, and again, start to think more strategically about the markets and start to really expand our analysis. So instead of just looking at these indicators in a basic way, we can really start to think about the information that they're giving us on the market and the sort of opportunities that we can build around the analysis. Okay, so once more, we've covered a lot of material in that session, and as ever, I hope that you found it really useful and you're looking forward to testing this stuff out for yourself. As I say, there are so many different combinations of moving average settings and time frames that you can work on, and the same with the Bollinger Bands, that you can really get lost for days exploring this stuff, and that is definitely what I suggest you do. But to really work on identifying the settings that work best for you and that you find most useful. And guys, in the meantime, please head to the website www.littlefishfx.com if you want to check out a whole load more of free material. We also have the Forex Master course on the site, as well as our daily trade alerts, which are now up over 3,000 pips in 6 months. So if you're interested in those, then definitely check those out. And I will catch you next time. So thanks a lot for joining me today, and I'll see you next week. Cheers.